Audio test, audio test, audio test.
Audio test. Audio test. Audio test.
All right, we're good. That sounds good. All right. You need to turn that down. We'll listen to a little bit of music, do an audio test before we get to the 8 o'clock hour. And then at the 8 o'clock hour, we'll go ahead and get started. So let's do this a little bit. We'll move this up so you guys can't see that. Little house cleaning before we get going, right? Never hurts. So hopefully that covers that mess up. Sorry about that, everybody. And we'll get rolling in just a minute here. Let me just get my fan, get myself a bottle of water, and then we can get going. Let's see what time it is. So thanks everybody for coming on short notice again. Can you guys see that? I don't know if that's high enough or not. I'll turn up just a little bit higher. A little bit higher. We'll make this go up. Right? You guys don't want to see my monitor anyway. Right? You guys don't want to see that. That's looks ugly. My golf club. I don't mind if you see my golf club. Right? If we take that away. The other side's still a little low. All right, we'll fix that, and then we should be right at 8 o'clock. So let's finish up our house cleaning, and then we can kind of get rolling. So obviously you can see my soda, right, and my bottle of water. So let's move that over there so it doesn't distract. Let's take a quick peek what time it is. What time do we got here? We got 7:58, another minute or two, and then we'll get rolling. So, and then if anybody has any questions or anything like that, feel free to ask away. I'll be glad to answer anything. So, just cleaning up the my iPad so I can see, and we'll get ready to roll in just a minute here. All right, so clean up my board. I've been writing on this board for the last couple of days, and it gets so dirty. I don't know how to get it. I don't know how to get it clean. I don't know how to get glass like squeaky clean. I might try. I heard alcohol does it. I don't know. I don't know what the hell to try anymore. But we'll figure it out. We'll figure it out. So, all right, another minute, we'll get rolling, and we'll get into the debt service covered ratio loan. And what I'm going to do is I'm going to put up this information. Oh, that's obviously not going to work. There's no ink in there. Where the hell's the ink? Can we even see that? Yeah, I guess we can. All righty. Hello, everybody. Welcome to the Golden Triangle Academy, the school for real estate investing. My name is Vinny. Sorry about that. Just finishing this up real quick. So let's get going. Sorry about that. All right. All right, everybody. Hello. How are you? My name is Vinny. I'm the teacher at the Golden Triangle Academy. For those that don't know who I am, I have owned a mortgage company for over 3 decades. I'm retired now, and I just teach at the Golden Triangle Academy. I owned millions of dollars of real estate, hundreds of homes. We were buyer and holders. We did everything. I went from Section 8 when I was a kid all the way up to $2 million single families. Me and my wife, we did corporate rentals. At the end, we had a lot of homes. Okay, we owned a credit repair company that went along with our mortgage company, and I built multi-million-dollar properties as spec homes. Okay, so spec home and speculation just means I built it and hopefully somebody bought it. All right, so I think I'm well versed on this information so that I can give it to you. Now that I'm retired, I want to let you know who the best mortgage broker in town is. She's an expert at this Dscr loan. She's been in the business probably longer than, she has been in the business longer than me. She's an unbelievable broker. If she can't get it done, there's nobody that's getting a deal done. She's fantastic at FHA, VA. She's fantastic at Dscr loans, Fannie, Freddie. It's all piece of cake to her. So I'm telling you, if you need a loan, investment property, whatever it is, give her a call. The name of her company is Mainline Mortgage Company. This is her cell phone number, and her email is amy@mainlinemc.com. So if you need any debt service ratio, covered ratio loans, if you need regular lending, she's the one to go to. Trust me when I tell you, I've been doing this stuff a long time. All right, so we're going to get right into it. It's not going to be a very long video tonight because there's not much to this stuff. So what I'll do is I'm going to give you the difference between what is a debt to income, right, and what a DSCR is, debt service covered ratio. So let's first go over here to debt to income ratio. What is it? Okay, for anybody that has gone and tried to get a loan, okay, which I call 2+2, right? That's just your normal everyday lending, okay? And for anybody that's done that, this is the process that it takes to get a loan. The first thing is that you're going to fill out an application, okay? And it's all your personal information. It used to be 3 to 4 pages long, okay? I know it's longer now. I don't know how many, Amy will tell you, but it's your personal information. That's number one. Number two, they're going to pull your credit, okay? So you need a minimum credit score, 580 to 620, right? So we'll just put the 580 in there because that's FHA, all right? Number three, you need a job history, okay? Want to make sure that you have a job. You qualify, right? So they're gonna make sure you have a job and you're working. Number four is going to be money down, okay? Or equity on a refinance, okay? Now, you could do no money down loans. I know that my wife does no money down loans, okay? You can go FHA with a down payment assistance. You can do FHA with grants. You can combine the two. You can get a lender credit. So you can do homes with no money down. You could do loans, you know, doing creative financing, but that's not what we're talking about tonight. We're leaving creative financing out of this talk. So money down, and then the last but not least, and the thing that we're talking about tonight, is your debt to income ratio, which needs to be 40% or less. Okay, so this is what it takes to get a loan. All right, your 2+2 normal way. Hey, me and my wife want to go buy a house. We see that house. We want to go live in it. We want to raise a family. This is the process that you would go through to get approved for a loan. So now, DTI, debt to income ratio, debt to income. How does it work? Okay, first off, it's a residential product, meaning Fannie Mae, Freddie Mac, FHA, VA, USDA. So it's a residential program, okay? And you and your spouse or whoever is applying for the loan, you will qualify for the loan, right? So you personally will qualify, which means you're going to give up your tax returns, you're going to give up your bank statements, all that stuff, right? All this stuff here, okay? So you got to qualify for a loan. Now, how does a DTI work? This is the last thing here. Well, this is the way that it works. They're going to take your principal, interest, taxes, and insurance payment. They're going to add all your monthly debt to it. Then they're going to divide it by your gross monthly income. Now, that needs to be at a 40% or less. And these are full doc loans, meaning full documentation. They're going to document the loan. They're going to document your W-2s. They're going to document your pay stubs, right? They're going to pull a 4506 and go to the IRS and to see if you're telling the truth, all right? So that's what a full documentation loan is. They're going to verify all that stuff for you, all right? So if we were going to do something like how we would qualify for debt to income, I wrote a little scenario so I didn't have to pull out my calculator, right? So if we had, let's say, a $250,000 loan, right? This is the actual loan, okay? And we'll just say 7% for 360 months. That monthly payment would be $1,663. Then we're going to add taxes, right? This is principal and interest, right? You got that through a financial calculator or an app. So you're going to add your taxes, then you're going to add, right, homeowners insurance, and your total payment would be $2,129. But that's only the first part. That's number one right here. That's PITI. Then what you need to do is you need to add all your monthly debt. So in this instance, they have a car loan, right? They have a student loan. They have 2 credit cards. Actually, they have 3 credit cards for a total of $549. So if you added this and this together, you're going to get a total of $2,678. Now let's assume that they make $92,000 a year combined, which equals $76.60 on a monthly basis. Okay, so this is pre-tax. This is a gross. Now, if you take this $2,678 and you divide it by the $76.60, you're going to get a 34.9% DTI, debt to income ratio. Okay, so that's how that works. You're going to add your PITI, which you get from your loan amount, right? You take your loan with your interest rate. You're going to add your taxes and your homeowners, and you're going to add all your monthly debt to it. Add the two together. You're going to get a total payment. You divide that by your gross monthly income. If it's 40% or less, you qualify. Now, let me just tell you this. I've seen 50, 55, 60% get approved. Now, you better have a lot of assets, and you better have super strong credit, right? You better have a good loan to value, but that will get approved if those things happen, okay? So if you got strong assets, strong loan to value, right, strong credit, they will go to a 60%. I don't recommend it at all. I like to stay around 33%, and I'll explain that later on. So that's how you would qualify for a loan. You personally, that's how you would qualify for a loan. Now, if we get into DSCR, which is debt service covered ratio loan. Debt service covered ratio loan. Now, like this over here was a residential product. This over here is a commercial property, okay? It's done a lot in commercial financing, all right? And this, the property qualifies, not you. So over here where you're doing this, you're not doing it over here. Now, they're pulling your credit. You still got to sign for it, right? But they're not verifying your income. Their property is the one that they qualify, okay? Now, how do they do that? Well, they use a debt ratio. Right here, debt ratio. Now, how do we figure out a debt ratio? Well, this is how they do it. They take the net operating income, or NOI, right? That's usually the rents, okay? So the rents is your net operating income. Then they divide it by the debt service. Now, what's a debt service? A debt service in the residential world is your PITI, okay? Your principal, your interest, your taxes and insurance, and if there's any other debt that's included in there, but mostly it's just your PITI. So if that number, usually that number, they want to have it right around 1.0, okay? The property qualifies and you can get a loan based on that. Now, again, Amy can go down to 0.75. She's got 0.75 and 0.85. Now, when you're dealing with bigger commercial products, they like to have like a 1.2 or a 1.3 when you're dealing with much bigger loans and much bigger programs, okay? But for residential products, you're talking about a 1.0, but there is loans out there. Okay, Amy has them. You can go as low as a 0.75. So let me show you how that works, all right? So let's say there's a 4-unit. 4-unit, okay? And let's just say each one makes $2,000. Oops. Okay, each one. So you're at $8,000 a month. This would be your net operating income, okay? Your rent would be your net operating income, $8,000, all right? Now you got to find your debt service. So, all right, we did a 4-unit, we did $700,000. Now the reason why I did this is because one of my students actually has a loan, a 4-unit going right now, okay? And we did it at 7% for $360, all right? That came out to $33.26. We added $500 in taxes and $330 in homeowners. Okay, that's $41.56. Divide that by 8,000, and what do you get? You get a 1.9. The higher the number, the better. That means it's cash flowing. Okay, it's cash flowing. So, the way again debt service works. Debt service is your net operating income. Your net operating income divided by your principal, interest, taxes, and insurance. Now, a lot of these lenders, okay, they'll go to 85 LTV. But I just want to tell you, when you go and you try to do an 85 LTV debt service cover ratio loan, because it's basically a stated income product, you're going to be paying a higher interest rate, okay? They're not as good as the Fannie Mae, Freddie Mac debt to income ratio, okay? And with the debt to income ratio, that's with any loan that you're doing, okay? Whether it's an investment property, whether it's an owner occupied property, okay? That's how you're going to qualify no matter what. If you use a debt service, if you do a debt service loan, okay, it's basically used for investment properties, and you do not have to show your own personal income at all right? So it's, again, just the property qualifies for the loan. That's it. Now, I'm going to show you some highlights, and I'm going to show you, I actually had Amy send me over some lender information, and then I'm going to show you just how to use the DTI. I have a form that I can show you on a debt to income. I'm going to show you that. All right. So, again, this is easy stuff. All right. So you're going to hear a lot of people I see, well, my students show me, I don't go out looking for this stuff, but a lot of them talk about, hey, I saw on Instagram, they're talking about a BRR loan and doing it as a no income with a debt service. So yes, what you can do is you can go up to an 85 LTV, which means you can borrow 85% on a loan that you could do a stated income product. It's basically a stated income product, and that's what it is. Okay. Now the reason why it has to go commercial, and the reason why they use a debt service and not a debt to income, is because after the collapse in 2008, they did away with stated income products with Fannie Mae, Freddie Mac, and all that stuff, right? So the Dodd-Frank rules don't allow us to do that type of lending anymore. All right. Now with the debt service covered ratio, it could be any size property, where with a debt to income, you are limited to a 4-unit property, because 4 units is what Fannie Mae and Freddie Mac deal with, okay? They deal with a 1 to a 4 unit. They deal with owner occupied, they deal with second homes, and they deal with an investment property, okay? And every one of those, you're going to use a debt to income, which means you personally are going to have to show your tax returns. You're going to have to show your W-2s, your pay stubs, your bank statements. On a debt service covered ratio loan over here, again, you don't have to show it. So if you're trying to do the BRR method, which, trust me, that's not an easy method, right? Because I don't know where you're buying property for such, especially in this market, where you're buying property so inexpensive at, right, to have that type of equity. But so if you go, you find a cheap property, you fix it up, you can go refinance at 85 LTV, where on a rate and term refi with Fannie Mae, Freddie Mac, it's a different loan to value ratio, okay, because you're doing a cash out. So if you ever want to know the loan to value guidelines, how much can I borrow? If you just go to Fannie Mae, I should have had this up for you. You can click in Fannie Mae LTV matrix, and you'll see here, everybody at our academy gets one of these binders. right? And in here is going to be your LTV guidelines, right? So if we just pulled it up, and I should have had it ready for you. So if you do an investment property, okay, on a purchase of 1 unit, it's 85. A 2 to 4 unit, it's 75. A limited cash out, which means you're not taking any cash out, you're just paying your mortgage off. On a 1 to 4 unit, 75. 1 to 4 unit, 75. On a cash out refinance, and again, that's where the BRR method, 2 to 4 unit, 70. Okay? So if you just go and you look up the Fannie Mae matrix, you will see all that stuff in there, okay? And everybody who joins the academy, you get a binder with all that information in it anyway. So what I'll do is I'm going to show you what lenders look like, what mortgage brokers look at, right? When they look at a property, and I'll kind of show you how this is done. So let me switch over real quick, and I'm going to switch to a different screen here, and I'm going to show you something. Okay, so what I have in front of me, this is actually what a mortgage broker would look at, okay? What a mortgage broker would look at. Let's do a nice, let's do an orange color, right? So as you can see, this says debt service covered ratio, investor loan size, right? This is as of 8/31. Now, I don't know if I'm supposed to be actually showing you this, but I don't care, right? So let's go down the side, and I can show you what all this stuff means, all right? So you get an education on what mortgage brokers go through and what they look like. So if we look here, and we're going to start here, and we're going to work our way down to here, all right? And then we'll go, then what we do is we go this way. This is how we look at the chart, all right? So this particular lender is going to tell us what kind of loans they want. So let's look at what kind of loans they have, all right? So they want a single family, okay? A single property type, 2 to 4 units. What do they want to do? It's a purchase, okay? As is value, $1 million, purchase price, $1 million, leverage, 70 LTV, loan amount, $700,000. Prepayment period means if you pay it off before 5 years, you're going to get hit with a prepayment penalty, okay? It's fixed. Now, we have to go to another chart to look that up. The note type. The note is the IOU, okay? It's the financial terms of the loan. So if you went and you did a closing, and it's going to say, okay, what kind of note? They're going to tell you that you can do a 30-year amortization loan. So you can do a 30-year fixed rate is what that's telling you, okay? Debt service covered ratio, well, that's PITIA, and A is probably association. Like if it's a condo or a townhouse and you have an association, it's probably what it is. And here is their matrix. They want 1.3 to a 1.39, right? That's a lot, right? That's pretty high. So they want a lot of cash flow, all right? That's what they want. Now, what do they say? Okay. Oh, actually, this is in New York. All right, so this is, I guess that's why she gave it to me, because it's not in Philly. All right, so U.S. citizen, experienced investor, credit score. So this is the other thing. To do Dscr loans, they want good credit scores, okay? You could go to 85 LTV, but they might want 760 credit scores to do that, right? It's pretty high. So they want no mortgage lates in the last 12 months, no bankruptcy, no foreclosure, no short sale, and no deed in lieu. That's what all that stuff means right here, okay? So if you see the words no BK, that's bankruptcy. If you see FC, that's a foreclosure. If you see SS, that's a short sale. If you see DIL, that's deed in lieu of, all right? So they don't want any of that. So that's kind of what they're saying. That's what their deal was. Now, let's go take a look at this form here. So she sent this over as well. Let me see what this is. Oh, not that. Let me go to this one. All right. Here is another program highlight from another lender that she gave me. So let's take a look at this. DSCR equals gross income divided by PITIA. Again, this A right here is probably association. Okay? So principal, taxes, insurance, and association fee. All right? Because that's going to be included. The max loan that you can do is $3.5 million. So this is the highest this lender will go to. All right? 3.5. You can do 1 to 4 family properties and condominiums. So you can do that. Now, this is what we were talking about, right? You can go to 85 LTV for purchase, rate and term, and refi. For those that don't know how to get an LTV, it's very simple. You take the loan amount, right, and you divide it by the purchase price. All right, that'll give you your loan to value, right? So if you had, let me grab my calculator. So if you got, let's say, $100,000 purchase price, right? You just multiply it by 85%. That'll give you your loan amount. All right. So you take your loan amount, times it by 85 LTV, right? That'll give you your loan amount. All right. Now 75 LTV for cash out refi. Okay. Cash out. Now, what's the difference between rate and term and cash out? All right. Let me see if I can pull up let me see if I can pull something up real quick for you, so I can share. Let me switch back over to the big board while I pull this other thing up for you real quick. So the difference between a cash out and a no cash out. Let me just pull this. Let me pull this up so I can show it to you real quick. The difference between a cash out and a no cash out. A no cash out or limited cash out is what they now call it. We used to call it a rate and term refi back in the day. All right. They changed that terminology to a limited cash out. And what that means is this. I'm going to show it to you. So if you just bear with me for 1 second, I'm going to show this to you. All right. All right. So what's going on here? Why is this doing this? Hold on here. I got something going on here. Okay. Let's fill this in. All right. Let's just view full screen. All right, here we go. All right. So if we were going to do what is called a rate and term back in the day, this is back in the day, a rate and term. Now they call it a limited cash out. The reason why is this, okay? Because you can pay off your loan, pay off your existing loan, right? You cover your closing cost, right? So you pay off your loan, pay off your closing costs, and you can go $2,000 or 2%, whichever is less, okay? So if you have a $100,000 loan, it's equal. If you got a $200,000 loan, well, the most you're going to get is $2,000, and they'll call that a limited cash out. Now, the reason why they do this and call it that is this. Because you had a lot of dumb mortgage brokers that couldn't figure out a damn good faith estimate, okay? So they gave these mortgage brokers a buffer. So you can miss your good faith by $2,000. I mean, you got to be, if you're a mortgage broker that cannot fill out a proper good faith estimate and be within $50, you're not even worth it. Just get out of the business, okay? So I had it down to the dollar. I was within, $2, $3. And everybody always wanted the $2,000 on a rate and term. So on a rate and term, again, you're limited. So if you go and you look at your Fannie Mae guideline books, right, and you just do, let's say it's owner occupied, and you want to do a cash out, you're limited to 80%, okay? So you can't go any higher than 80%. Maybe that's all the equity you have in there, but $2,000 is $2,000. You can put it in your pocket. So a limited cash out, aka what we used to call a rate and term refinance, just means you can pay off your loan, cover your closing costs, and walk away with $2,000. And you're maxed out at, you could go on this here, you could go all the way up to 95% loan to value, okay? On a rate and term, you can go to 95 LTV. Now, let's look at a cash out. A cash out refi, okay? You're limited to 80 LTV. All right? Cash out is this. You pay off your existing loan. You pay your closing costs or cover your closing costs. And you walk with over $2,000 in cashola. Okay? So now, you want to buy a boat. And you'd rather buy cash, take the money from the home because rates are at 2%. Boat loans are at 10. Well, I'll do a cash out refinance, right? I'll buy the money from the boat. My house is owed. I could go to 80% loan to value, Again, it's the loan divided by the value of the house. So if you owe $100,000, but the value of your house is say $500,000, okay? You can take this and go to 80%, okay? So let's do it. So 500,000 times 80%, that's 400,000, right? You're going to pay off the 100,000, right? So you pay off 100, then take out, let's just say 20,000 in closing costs. That leaves you with $280,000 cash out. So that's the difference between a rate and term and a cash out for anybody that didn't know. All right. And this is the stuff that we teach at the Golden Triangle Academy, all this stuff here. All right. So let's go back to our board here, and let's go look at some of these highlights again. All right. So let's see here. All right. So 75 LTV on a cash out. Now, if you're doing the BRR method, this particular lender, right? They're only going to go to 75 LTV. All right. But they will do this though, right? They'll go to 620 FICO score. So they'll go as low as a 620 FICO. They'll do a non-wardable condo. Non-wardable just means, I'll get that later. Investment properties only. Okay. So here on this DSCR, they won't do second homes, no second homes, and also no owner occupied. Okay. So investment property only. No gift funds allowed, means you can't get a gift. No limit on finance properties. Now, this was a problem that I used to have, okay? I owned at one point, I owned hundreds at one point. But when I got into that was Section 8. When I got into the single family homes, we had so many of them, I couldn't get financing. It was very difficult. I had to get commercial financing. Fannie Mae has a limit of 10 finance properties. After that, you're going to be hard to get loans, okay? They're saying, hey, no limit on amount of finance property. If you own, like what I did, maybe 50 homes, you can still go get a loan. They'll still do a DSCR loan for you, okay? So that's what that means, all right? Leasehold properties are eligible. Now, leasehold is big in Delaware, not so much big in PA or anywhere else. Means that you don't own the ground underneath. When you buy a house here, you own the ground. In Delaware, you don't own the ground. You do a 99-year lease. That's what that is. So that's a leasehold, right? Short-term rentals. So if you're doing a short-term rental, right? If you're doing a short-term rental, meaning that you're doing Airbnb, you're doing VRBOs, you could do purchase, rate and term, and cash out. Okay. So if you're doing any of them, sometimes it might be a little difficult to get because you can't prove the rental income that much. Okay. So this particular one you can. All right. This form here. So that's just some of the highlights these banks send over. And we got all these different highlights. Amy sends me all these different highlights all the time. So I teach them to my students. So each individual, by the way, each individual bank will have these different types of programs. But I'm going to show you what goes on here, though. This here, let me just show you this. For those that come to the academy, here's just a simple form. This is your debt to income, right? So what we do here is this is just a like a pre-qualification form. So you put your name here, the bar's name. Here's the property address. Then this would be the sales price or the balance, your loan amount, your equity, your yearly income, right? And then the total gross monthly income, because that's the number that you want, right? So then you go down. Whoops, don't want to see that. They're going to talk about your credit, and then this is stuff for when you're trying to qualify for a loan, right? Whoops. What's going on here? Stop. I don't know why it's doing this. So you get your loan amount, and then this will give you your PITI plus all your debts right here. And then this down here will give you your, right down the bottom here, this will give you your debt to income ratio. I like to keep it around 33% is what I like to do. All right, now what I want to do is I want to show you, whoops, I switch back here. Sorry about that. What I want to do is, like I was telling you, every lender has different quirky guidelines, very small. But let me just show you how the money flows and why it doesn't matter what kind of mortgage broker you go to or what kind of lender you go to. They're all the same. What separates somebody like Amy versus somebody down the street is this: A, service, and B, knowledge. Okay, everybody has the same lender. Because let me show you how the money flows so you can understand the DSCR loans, everybody has the same product. Because here's how the money flows, just so you understand. Okay, let's just say this is you and you want to go buy a home. And we're just going to talk about an owner-occupied house. So what are you going to do? You're going to go to a realtor, okay, for the most part. Or you might go directly to a broker or a bank, okay? Okay, if you got a friend's broker bank. Now, the realtor is going to send you there anyway. Now, you could go to your credit union. You could go to the local bank, right? You can go wherever you want to get approved. And the way that this would happen, so I'm going to go with the mortgage broker because that's what we did. All right, so now that you're at a broker, we go to the broker, okay? And what do? We pre-approve you, okay? And we do all the stuff that we talked about. Whether you're going DSCR or you're going Fannie Mae, Freddie Mac, VA, FHA, doesn't matter. We pre-approve you. We get your stuff done. We get it ready to go. Now, what separates a broker from another broker? Again, not much. The things that separate Amy from everybody else is this. She's got about 40 years of experience and a shit ton of knowledge, okay, and has done probably 10,000 deals or more in her lifetime, okay? So she knows how to get stuff done. That's the difference. You go down to another person. Oh my God, I can't even tell you someone. Because I retired, I hit about 28, 29, maybe I was 30 years old. And I retired because I owned a lot of properties. And I was a mortgage broker as well. Just tell you a quick story. And a friend of mine who was a mortgage wholesaler, I'm going to get to this in a second, asked me to help him out, get a bunch of brokers signed up for him. I'm like, John, I'm retired. I'm confident. He's like, yeah, just do it for a couple months. And I did. And I went and signed up a bunch of brokers for him. And I got to tell you, they were morons. Morons. I was like, how are you even licensed? So I was so happy when 08 and they all got eliminated. It was the best thing that ever happened. Because I'm telling you, there's a lot of dumb ones out there, and I feel bad for whoever goes to them. Okay, so now what we do is we get you pre-approved and actually get you approved through what we call AU, right? Automated underwriting. That's the Fannie Mae product. Now, what do we do with it? Okay, we don't give you the money. We send it to a mortgage wholesale bank. Okay? Now, these guys, they're a dime a dozen too. There's a million of them, just like mortgage brokers, dime a dozen. What separates them? Basically nothing, right? They all have the same product. Because listen, after 08, everybody could do the same thing. You have Fannie Mae, Freddie Mac, VA, FHA, USDA. There's no more subprime. So all those mortgage wholesalers went away. Then what came out was the non-QM, which is non-qualified mortgages, okay? Qualified mortgages is your typical 2+2 lending, Fannie Mae, Freddie Mac. All right, now, these mortgage wholesalers, they could do your non-QM, right? And they could do your 2+2 Fannie, Freddie stuff. Now, what do? Okay, they dot the I's and cross the T's on our loan that we send over, okay? They also do all the approvals, and they send all the money to the closing table, right? So they send everything to the title company. What do they send? They send the papers and the money, okay? Now, these guys don't have any money either. Where do they get their money? Okay, well, they get a line of credit from who? From Wall Street. These are the big bankers, right? Now, the big bankers, do they hold this money? No, they've got all the money, but what do? They sell it as a mortgage-backed security. Who do they sell it to? They sell it to Fannie, Freddie, and then the non-QM buyers, right? The investors who buy it. Now, these guys make up all the rules and regulations because they buy it. We follow Fannie and Freddie Mac. So do these guys. So there's not many people here, okay? They're the same couple of banks. So what do? These guys make the rules, send the rules to these guys. Okay, we'll buy your products. Just make sure you follow our rules. They say, okay, well, Wall Street doesn't want to deal with this guy. They only want to deal with this guy. They only want to deal with this guy. These guys don't want to deal with this guy. They just want to deal with this guy. Okay? This is how it works. So now Wall Street gives these guys a line of credit. Okay? And they use that money to send here to give this person one. Now, when they have enough loans, right, they send all the loans right here, right? And Wall Street, what do? They bulk them up. And then they sell them. So you see, there's no difference of any different mortgage wholesaler. All the products are the same. You might have one that does something a tiny bit different than the other, but it's all service. It's all service and knowledge that gets this stuff done. Okay? So it really doesn't matter what mortgage wholesaler you have, right? I know that Amy has probably 10 different wholesalers that call her up and say, hey, I want to sign you up. I want to sign you up. I want to sign you up, right? So she's got 10 different wholesalers that she's getting signed up with, right? Okay? They all have the same product. It's all Fannie Mae and Freddie Mac. Now, the difference might be mine might have a little bit better interest rate. I'll give you a for example, okay? When I was in the business, I had 3 lenders they were my go-to lenders, okay? The one bank was called Provident Funding. Great, the best rates in town. I could take them there and make more money, right? But if it wasn't a perfect loan, they weren't doing the deal. So I had to have another lender. They look for reasons to deny loans. So it had to be a cherry loan. Okay, so now we know what that lender does, okay? Now, the other lender I had, they looked to approve loans, right? But you paid a higher interest rate, okay? And their service wasn't as good, but they got stuff done and they got it approved. Okay, so the harder loans, we sent to that one. Then we had our no-doc stuff, so we sent it there, okay? So, but all the rates are all the same. We only use certain people because of the service that you get, the service and the knowledge. So it doesn't matter where you go. At the end, we're all following the same rules and regulations that were set up by 1 or 2 banks. They all have the same rules and regulations. Okay, so now, doesn't matter where you go to, the DSCR is all going to have pretty much the same qualifying stuff that these lenders want. Okay, and what I was showing you earlier, some of the qualifying stuff is this. We'll do 1 to a 4 unit. Some will do a 5 to a 6. Some will do up to a 10. Some will do condos, right? Some will do all the different stuff. Some will go to 85 LTV, but you got to have a 760 credit score, okay? So again, it's a very easy formula, right? What's the formula? Again, it's net operating income divided by your debt service. Okay? Net operating income, that's the rents, divided by your PITI. And that's it. Again, 1 point or higher they like. Amy says she has 0.85 and a 0.75. Now, obviously, just so you understand this, when you get down to these type of numbers where there's not much cash flow, you better have good credit scores. You better have good credit scores, okay? You better have good credit scores. And this might be a 75 LTV, okay? They might not go to 85 on that. So it's all a trade-off, right? It's all risk-based, okay? So it's all risk-based. You might be able to go to 85, but you might need 760 credit scores. What happens if you don't have 760 credit scores? Okay, well, you can't do 85%. All right? So this is all that it is. That's it. It's a commercial product that you don't qualify for, the property qualifies, okay? The property qualifies. Okay? And it's basically what we call a stated income product. A stated income product. Which means no W-2s, no pay stubs, right? No tax returns. All right? You still are going to have to sign for the loan. I mean, you still personally going to sign for the loan, and you still need good credit. But it's out there. It's a good program. If you need to do on your investment properties where maybe you're writing everything off, okay, as much as you can, and you're showing nothing, and you want to be able to buy property or refinance property, this is the way to go right here, okay? Let me see if there was anything else on that other form. Let's take a quick look at this other program here. Let's see if there's anything else I can show you on that. Let's take a quick look at it. I'll put it up on the screen in a second. I just want to take a quick look to see if there's anything on there that we can take a look at. If anybody has any questions, I'll be glad to answer anything anybody has. There's really nothing else in there, right? It just has the rates, okay? And I think really it's just, again, it's the same thing It's the same thing as if you're going to qualify, except for the property qualifies. All right? Very simple, simple stuff, right? Net operating income, that means rents. Divide that by your PITI. If you got a 1.0 or higher, you know you're in good shape. If you have it lower, you better call Amy, find out what the loan to value is. All right? So there's the difference. DTI, debt to income, it's residential property and you qualify. And over here, it's commercial property. But again, it could be residential property. I didn't mean, I kind of misspoke there. Let me re-say that. This over here is a residential product, meaning that it's used for Fannie Mae, Freddie Mac, FHA, and VA, and you qualify. The DSCR is a commercial product, but used on residential properties, okay? It could be used on a single family. It could be used on a 2-unit, 3-unit, 4-unit, 5-unit. It could be used on stuff like that. It could be used on a mixed-use property. It doesn't have to follow these guidelines over here. So if you got a mixed use, right, that maybe the seller will hold back a second, you can do a stated income product. So that's all that it is, all right? It's a simple, easy formula. Net operating income divided by debt service, 1.0 or higher. If you need to go lower, call Amy. She'll give you the loan to value stuff. That's it. By the way, the higher the number, 1.1, 1.2, 1.3, that means it's more cash flow. The higher the number, the better, okay? The higher the number, the better. The lower the number, not so good, all right? So that's debt service covered ratio loans. That's all there is to it, okay? And again, if you need it, you call Amy, she'll help you. She's a whiz at them. She's great at them, okay? I don't do them anymore. I haven't done any of these deals in a long time. And when I was on my mortgage company, we had stated income products. We didn't have to do this stuff, right? We just do a simple no doc. All right, so I don't see any questions, so I'll wrap it up with that. So there you go. All right, debt service covered ratio loan, very simple. And if you want to know anything about the Golden Triangle Academy, right, let me tell you a little bit about that, and I'll wrap it up with that. So the Golden Triangle Academy is a school for real estate investors. What I saw out there was a need where there was nowhere out there to learn real estate investing. I saw all the gurus out there that were charging outrageous amounts of money to go learn shit like subject to financing, lease purchases, right? Shit that I've been doing for 40 years, okay? And trust me, subject to is not the greatest thing out there, all right? And nobody was teaching the basics. Everybody's teaching get rich quick. That does not work. Okay, if there was, there'd be millions of real estate millionaires running out there. The only one who are millionaires are the guys on YouTube, right? They're the only millionaires that I see. The only ones that I know. Okay, a couple of my students have gotten rich. But, so I teach everything that I learned over the last 40 years, which is real estate investing. It's mortgages, AKA money, stuff like this. It's appraisals, it's credit, it's all of it. So the three pieces of the Golden Triangle are basically this, okay? It's real estate and real estate investing, okay? It's money, which is mortgages, okay, and credit. All these three things have been a part of my life for close to 40 years, and I teach all of this stuff. I give you a super solid foundation. How much is it? It's $59 a month. That's it. And I teach everything. Every different type of investing that you want to learn, you get it. I have live class every Monday night. We have class. I live stream a lot of stuff like this every now and then. If anybody wants to learn something, there'll be step-by-step instructions of everything out there. So like if you want to learn about short sales, step-by-step instructions. You want to learn about foreclosures, step-by-step. You want to learn about the BRRR method, I'll have step-by-step instructions. Wholesaling, subject to, contract for deed. All those things will have step-by-step instructions, give you my opinion. Plus, you're going to get all the contracts, everything that you can need, you'll have it. I've got every contract for every situation, okay? My private students, that's a little bit different. That's where I'm kind of like your partner. I help structure deals, things like that. I talk to the sellers, talk to the realtors for you. I'm basically your partner. I'm like, I stand next to you. That's our private students. But for $59 a month, you can learn all of this stuff, right? You're going to learn the values. You're going to learn all the Fannie Mae stuff and their rules and regulations. Hell, matter of fact, a couple of people that were in my class went on to become mortgage brokers, right? So you'll learn creative financing, right? How to buy property with no money down and not the junk you see on YouTube, right? You'll learn all of this stuff. So you learn all this stuff, right? And then the biggest thing is you got access to me. So if you want to learn more about the Golden Triangle, you can just do this, right? Text the word golden to the number 21,000. That's my digital business card. Okay, my cell phone number's on there. You can call me. I'll talk to you all you want. Okay. And again, if you want to join, it's $59 a month. That's it. All right. So thanks for coming. I appreciate it. That's all I got for you tonight. Dscr. There's not a lot to it, right? It's very simple. It's net operating income, which is your rents. Divide that by your debt service. If you got 1.0 or higher, you're in good shape. All right. All right, everybody. Beans, we got no questions. I'll see you guys on the next live stream. Thanks for coming. Got to turn it off now. Got to go find my switch to turn it off. But can't find it. There it is. All right. Thank you.